Is prime central London homes facing a full-blown crash? There's areas of central London now where the homes are selling for the same price they did 10 years ago, and some even at a loss. Prices are down 25% in some postcodes in just 2 years. While agents talk the market up, statistics actually tell a different story. Now, welcome back to the channel, guys. My name is Malky Pirawal, one half of Savoys Properties. We've been in the industry for over 2 decades. We specialize in HMOs and commercial to residential. And we've avoided the central London market for many years. And today we're going to explain why. So what does the data actually show? Well, I've got some stats here, which I'll run through with you guys. In the West City of Westminster, house prices have fallen 25% since January 2023. Now averaging £920,000, down from a previous average of 1.2 million. In Kensington and Chelsea, the fall is even steeper at nearly 29% since 2021. In Marylebone, homes are selling 88% of the original asking prices. That's a £120,000 drop on homes listed at £1 million. And 35% of sales are falling through. That's well above the UK average of 24%. That alone should raise some serious alarm bells. Now, the real reasons behind the crash, this isn't something of a blip. This is structural. I'm going to run through our views on why this is actually happening. Now, you got the removal of the non-dom status, basically allowed foreign nationals to come to the UK, not pay any tax on what they're earning outside of the UK. This basically allowed millionaires and billionaires to actually reside in the UK. And for us, I thought this was a good thing because it has a trickle-down effect. You've got people that will not traditionally live in the UK come, spend money in restaurants, shops, and you actually saw a lot of creativity come from these guys from actually being in the UK. There's a stat that basically shows that up to today, 15,000 millionaires have actually left London and they're now residing in other areas of the world, such as Monaco, Dubai. This is actually having a big impact on prime central London homes. Then you've got the interest rates that have come in. They've obviously increased, previously up from what we had at 0.5%. We went all the way up to 5.5 and we're now back down at 4.5%. This is obviously a big impact on some of these high ticket homes. Remote working. Following COVID, we saw a lot of working from home. I actually knew a lot of friends that were working in central London that moved back home with families or rented in other parts of the country because the job now allowed this. We then saw less demand in central London for, say, HMOs, shared housing, self-contained units. And this has obviously had a big impact on that. Stamp duty changes. Now, following the new government that came in, they introduced some stamp duty changes. So this probably impacts people living in other parts of the UK a little bit less, but there was some impact. But in central London, where you've got an average price around that £1 million mark, the impact was big, and you can see why it would have an impact. If I was buying a house in central London, I would actually tell the agent, look, my stamp duty is now increased. I'll buy this home, but I need this stamp duty amount taken off what my offer price is actually going to be. The final point being Brexit. Now, following Brexit, a lot of companies had to relocate to other areas of the EU for regulation purposes. This actually saw these jobs being moved from central London to other parts of the EU. You only have to go down to the city. We'll come down to one of our Elevate events which is actually in the city, but when we're walking around there, you'll see so many to let signs, and there's some buildings that are completely empty still. And this is obviously having an impact because these are the people that would traditionally fill a lot of these prime central London homes as renters or even purchasers. Now, all of this put together is a perfect storm for prime central London homes. So for myself growing up, central London used to be the place that celebrated wealth, celebrated life. It's a place that you really wanted to live. Now, put all these factors together, it's a perfect storm for a prime central London housing crash. Now, why have we at Savoys avoided prime central London homes? Well, we have a few investments in Ealing, Acton, and as far in central as Holland Park. We're traditionally focused on the outer boroughs. The reason being, in central London, houses traditionally have increased faster than other areas of Greater London and the UK. But this meant basically the prices were actually high to enter and the yields were quite low. But this was made up with high house price growth. We traditionally focused on outer boroughs of London, such as Hillingdon, Ealing, and some of the home counties such as Buckinghamshire and Berkshire. The reason being the barriers to entry were low, so we could purchase a house for probably a quarter of what it would cost to purchase an average property in prime central London. And the yields were still pretty high and typically 2 to 3 times what they would be of central London homes. This basically gave us the best of both worlds. The other reason we wanted to focus on average homes for average people, because this is a wider range of the housing market demand. And we knew even in the event of crises, and we had several of them during our time, we had the dot-com crash, 9/11, we've had the 2008-9 crash, and then up until recently we had COVID as well. During this whole period, we saw strong growth and demand for the properties that we were producing. So what works today? Well, nothing fundamentally has changed. Average people still need properties to rent, so we believe you're best off focusing on average homes for average people. These are working professional tenants that are working in our town centres up and down the country, and we still see strong growth and demand there. Now, take this building that I'm sitting in today. This was a dilapidated block of 6 commercial units and 3 duplex flats. We were able to change the uppers under PD to 16-bed HMOs and then repopulate the commercial units. Why do we choose this location? Well, it was right next to a HS2 development. It's a 20-minute train ride into central London, and the average people needed average homes to rent, so it was a win-win. Plus, by only spending £300,000 on a £2 million investment, we were able to double the value of the building, basically meaning we were able to pull all our money back and have a high cash flowing asset. In today's market, it's more important than ever to focus on high cash flowing assets that will produce a nice revenue for yourself after all expenses are paid month after month and year after year. My takeaway on this is we're actually going to see a lot of dinner party landlords that used to say, well, I own a flat in Chelsea, I own a flat in Mayfair. These guys are actually going to be exiting the market, and where the real growth and opportunity is going to be is the savvy investors that are looking at transport links, looking at where the investments are going to be, having properties where you can take a short train ride straight into central London. Just take the HS2 line that's going to come in and the Elizabeth line. There's some great opportunities up and down those lines where you can be in central London, but you don't have to be living in central London to actually benefit from it. I see central London struggling for the next few years, particularly under this government, and it may take a new government to see some initiatives, some growth to come back into central London, and a reason for people to actually live in central London. Now, if you found this video helpful, make sure you like, subscribe, leave a comment. We're back each and every week. We've also got some free resources to help you guys find your next deal. We've got a deal analyzer, which we use on each and every one of our sites. Check out the link in the description, and we look forward to seeing you in the next video.